Kenya has borrowed $1.5 billion, which is about 195 billion Kenya shillings, from the international capital markets by floating a new Eurobond that matures in the year 2036. National Treasury Cabinet Secretary John Mbadi says the issuance is a strategic move aimed at managing debt obligations and maintaining investor confidence. As Wairimu Njenga narrates, the Eurobond will attract a 9.5% interest rate.
National Treasury Cabinet Secretary John Mbadi says even though Kenya was seeking to raise $1.5 billion, or about 195 billion shillings, by floating the latest Eurobond, the country received bids worth $5 billion. Mbadi says, and I quote, "Kenya's continued successes in the international capital markets underscores strong investor confidence in the country's economic management." End of quote. The latest Eurobond will be repaid in 3 equal installments in 2034, 2035 and 2036. The National Treasury Cabinet Secretary says proceeds from the latest Eurobond will help restructure external debt, with part of the funds allocated for the buyback of Kenya's 900 million USD, or 117 billion Kenyan shillings Eurobond, maturing in 2027. The final buyback amount will be determined based on market demand on Monday next week. He says the latest Eurobond issuance follows the full repayment of Kenya's 2024 Eurobond and aligns with the bottom-up economic transformation agenda that prioritizes debt sustainability and investor confidence. Currently, Kenya's public debt stock stands at 10.58 trillion shillings as of 2024, up from 10.27 trillion shillings in 2023. This comprises 5.1 trillion shillings, which is 48.9% in external debt, and 5.41 trillion shillings, representing 51.1% in domestic debt. As a share to GDP, the debt stock declined to 65.7% in June 2024, up from 72% in a similar period the previous financial year, mainly due to the appreciation of the shilling against major foreign currencies. In the medium-term debt management strategy, Mbadi noted that Kenya's public debt is sustainable, emphasizing the government's commitment to fiscal consolidation and ongoing reforms to reduce borrowing costs and mitigate future debt risks. Wairimu Njenga for Prime Edition.